Hello, everybody. My name is Darwin German, and we are going to present to you the Corners Apartments. But first, take a look at our video that we did for this investment.
Darwin German Real Estate is proud to present its next investment opportunity. The Corners Apartments provides DGRE investors with an opportunity to acquire a Class C garden-style apartment complex located adjacent to a current very successful DGRE property. Located in DeSoto, Texas, just across the street from Riverbend Apartments, this two-story brick property consists of 85 units built in 1983. The Corners amenities include a swimming pool, basketball court, tennis court, playground, and a leasing office. Just west of the intersection of Interstate 20 and Interstate 35, Corners is ideally located just minutes away from sports and entertainment parks, city services, and a wide variety of shopping venues. Corners has 45 one-bedroom, one-bath units at 663 square feet and 40 two-bedroom, two-bath units at 936 square feet. The Corners will present an upside opportunity with a capital improvement budget of $5,900 per unit to address deferred maintenance and renovate interiors in order to hold for long-term cash flow. As with all DGRE properties, significant tax benefits will be achieved through accelerated depreciation. The Dallas-Fort Worth market continues to be a top national leader for job production. The area supports over 3.5 million workers. Future job growth in DeSoto over the next 10 years is estimated to be 38.5%, which is higher than the U.S. average of 33.5%. The projected population growth within 3 miles of the property is expected to grow by 8% over the next 5 years. We are excited about adding the Corners to the DGRE portfolio and excited about making this available to the family of DGRE partners. Please reach out to the Darwin German Real Estate team to discuss this exciting opportunity.
As you can see, the Corners Apartments is just beautiful. And to recap some of what you already saw, is the Corners Apartments is right next door to another property we have called Riverbend. Now, this is actually adjacent to Riverbend. So the benefit here is the Corners is only 85 units, so we can absorb and manage both of those properties through the Riverbend office, saving payroll costs for both the Corners Apartments and for Riverbend. So that's a huge benefit to us right there. And this is a gorgeous property. Ironically enough, when I first started in this business, the Corners Apartments was one of the properties that we represented the buyer, then we managed it, did asset management, and held it for about 10 years and sold it in 2001. We bought it in 91 and sold it in 2001. And in this picture here, the sports court that's on there was actually a sports court that I put in on the property. So it's funny that this comes around that way and that now we're back into this same property. It's brick and stucco, built in 1983. It's a beautiful property, and being right next door to Riverbend is a huge benefit to us. So let's go through the numbers on this just a little bit. Again, this is in DeSoto, Texas. We're paying $9.1 million. We've got closing costs of $460,000. We've got capital improvements of $500,000 that we're going to put into it. We're going to open the operating account with $120,000, so we have plenty of cushion for times like COVID. Just to toot our own horn a little bit, we were prepared and had enough in reserves for about a 30% drop in revenue for 6 months. So because of that, we have been able to continue our distributions on our properties even during this very tumultuous time. And also our management company has actually increased our collections over what they were last year. So even during COVID, we've been doing that because we have reserves and we manage things right. So we're doing great there. We have $20,000 in miscellaneous costs just to round it off. We're looking at a $7.2 million loan. So we're only going to raise $3 million. Now, because this is a small deal and because it's a pretty private offering, you're not going to advertise this. This is available to our sophisticated and not accredited investors. Now, accredited investors still can invest, but this is the one that I told you I was holding out for our sophisticated investors. So everybody can jump in on that one now. So we'll be all in at $10 million too. Of course, we are the sponsor, our whole team. DGRE is a sponsor. We are holding back 17% ownership for the sponsor and 3% to the KPs. And we put in there a 3% commission in there, a acquisition fee for Darwin. We're looking at a $7.2 million loan. This is going to be, right now, debt quotes change and it always fluctuates. In the PPM here, we've got $7.2 million loan at 2.9% interest for 10 years. What we're actually looking at right now, the current quote is 2.91% interest, fixed for 12 years. 2.91% fixed for 12 years. And with 5 years of interest only on the green program through Fannie Mae. So a great, great loan. Can you imagine we're borrowing money at 2.9% interest? It's amazing. Our business plan is we're just going to hold on to the property, fold it in with Riverbend, which has been extremely successful. And we're looking at an average of 16.7% return to our partners per year on an average return. And it starts off right out of the gate with cash flow. So that is absolutely wonderful. Go through the numbers. Here's the unit mix. There's only 45 one-bedrooms and 42 bedrooms. That's it. So it's only 85 units total. And I want to go ahead and point something out real quick. The current rents are $1.28. That's their effective rents that they're actually getting. We are projecting $1.37. And the way that we're projecting that is there's already 59 of the units that have been upgraded. And so we're going to update the remaining 26 units, which is going to allow us to raise the rents on those units. Now at $1.37 a foot, I went back into my archives and I pulled this out. In 2001, so 19 years ago, the rents were 82 cents per square foot. If you take 82 cents per square foot and divide that by $1.37, we have had an average rent increase on that property over the last 19 years of 3.5% per year increase. Now that is going all the way from 2001, which was down, all the way through the bubble that crashed in 2008, and then back down all the way to back down when it dipped after 2008. From 2008 to pretty much 2012, and back up to now. The average is 3.5% increase in income. And we are budgeting on this a 3% increase in income over the term of ownership. So we're only looking at raising this pretty much to the rents that they're currently getting on their upgraded units. Okay, so very, very modest increase. 85 units built in 1983, 4.7 acres. Pitched roof, individual HVAC, individual electric, individual hot water. It's in great condition. It's owned by Madeira currently. This is an off-market deal we're picking up from Madeira. 2 stories. It's brick and siding. I'm sorry, it's brick and stucco, and it's on a slab foundation. We're budgeting $500,000 in CapEx. That is primarily for the other 26 units to update those, and then doing all of the exterior work, which is, there's not much, but updating those sports courts that I put in many years ago, and refreshing the exterior. There's not a lot to do, so it's a real simple, easy rehab. Now going through the current owner has provided us financials, and we went over those. That's showing their total operating income right now. Their collections are $1,148,000. I'm budgeting $1,202,000. So just a little over $50,000 in additional collections. So not a big jump in the amount of collections we're going to do. We did raise the rents slightly, but we also put in a larger 8% vacancy and collection loss. Pretty much left the other income just a little bit higher, because right now it's a little bit lower because of the inability to collect late fees. So once we do that, we'll be able to collect more late fees, because this current for the current owner is a T3 annualized. So those are a little bit lower. Plugged in all our normal expenses. The big thing I want you to look at is we're looking at $7,000 per door in expenses. $7,000 is extremely high, and even for this property. So we should be able to scale that back. But here's the biggest culprits. Look at insurance. Currently, they're paying $24,000. We're looking at $38,000 from our current quote. Insurance has gone up a lot the last few years. And property taxes, same story. $147,000 is what they were paying. We're budgeting $200,000, so a 30% bump in our property tax expense. And that's where the bulk of this increase is. We're actually looking at lowering utilities because of being on the green program. And other than that, not really saving too much money except on payroll, because we can combine the two properties and run them as one. Of course, the books will be separate. These will be operated as two separate properties, but the allocated time for the staff will be divided up pro rata on the amount of time they spend on each property, so that it's fair for both separate sets of owners. We've got company expenses, asset management fee, tax returns, etc. Plug in reserves of $250. And our debt service, we're going to have 5 years of IO. So our debt service is only $208,000, giving us $351,000 in cash flow. That's a cash on cash return for the property of 11.7%. Okay, so a screaming deal. And a 6.7% cap rate on our projected numbers. That is absolutely outstanding. Check coverage ratio at 2.91. It's huge. It's a great deal. So let's take this out to the 5-year. So our sponsor pro forma translates over into our year one projections. Now, the only difference here that I want to point out, because all these numbers are the same, with the exception of, first and foremost, I put in a higher collection loss of 3%. Let's match those up to 9%. Okay. So now our income is the same. Our expenses are the same. The thing that's going to throw this off is this partner loan interest. Now, I'm throwing this out for a very specific reason. The lender is now requiring us to put up reserves for principal, interest, taxes, and insurance. Now, that fluctuates almost on a daily basis. Is it 9 months? Is it 12 months? Does it include taxes? Does it include insurance, et cetera? So what we're doing is we're budgeting in that there's going to be $360,000 in lender reserves needed. So because it's only going to be in there for 9 to 13 months, we don't want to put that in as part of our capital raise. So as a secondary item, we are going to do a partner loan for anybody that wants to participate in that, and that's a straight 10% interest, and that gets repaid when we get those lender reserves released to us. So that's a $360,000 additional amount we're going to raise above the $3 million to go ahead and pay for anybody that wants to put that up just to earn 10% for that 1 year. Okay, so that's why that is a little bit off between the 340 and the 304, is because of that $36,000 that we're going to pay in interest to anybody that wants to do it as a short-term partner loan because of those interest reserves. Now, I want to go into the reason we're doing that. Is if I did that and we raised the extra money, it raises our capital outlay. It lowers the yield. Then if it's paid back between 9 months and 13 months, then we have an influx of cash that would go through our normal program that would be split up at an 80-20% level. And that's not fair to you guys to put that up and then have 20% of that for such a short period going back to us as sponsors. So we are raising that extra money as a partner loan and then paying those partners 10% interest for that year and paying the interest out of the property, but not counting that in and out of that $360,000. So I hope you follow that and doesn't confuse you. Bottom line is there's $36,000 expense for that, giving us cash flow of $304,000, 305 basically, which is 10.2% return on investment in year one. That is for the property level. We've taken this out 5 years. I budgeted in there a 3% rental increase. I already back tested this all the way to 1991, and we've had an average of 3.5% increase per year over the last 19 years. Increase the expenses 2% per year. Our collection loss year one is 3%, and then 2% every year thereafter. And so we extrapolate all those numbers down, and it shows us going out 5 years on taking our cash flow from 304 in year one to 451 in year 5. Now we're valuing this at an exit cap rate of 6%. So that would be a value of $12 million, roughly, just so that you can see this real quick, because I really think that interest rates are going to stay low, and I think our exit cap rates are going to be lower than what I project. So just to give you an idea, if this were a 5.5 cap rate, it goes to almost $13 million valuation, and our return jumps to 22%. So if cap rates stay low, and we can sell this in 5 years at a 5.5 cap, we're talking about a 22% per year average return as opposed to the 16.7 that we have. So now I'm going to put that back where it was at a 6 cap, giving us almost $12 million. So the 5.5 cap is $1 million more. Now, all that's fine and dandy, but somebody might say, what's in it for me? And that's why I do this here. This is the property level. That's what the property produces. Now, if you invest $100,000, for example, this is what you can expect. You can expect year one an 8.1% return on investment. Spectacular first year return. Year two, invest $100,000, get $10,000 back or 10% return. Year three, 10,700, 10.7. Then 11,000 or 11.4. Year five, 12,000 plus on the sale, another $131,000. It's a total of 143% return. Over 5 years after your return of capital, that's 16.7% return per year average on your capital. Now, this does not take into account the accelerated depreciation that we're going to put in place, give you a huge tax deduction, and give you a great return on a property that we can just fold in with our existing management next door. And to give you an idea, this is something else that I like to do. The valuation that we're using at that 6 cap is showing a value in year 5 of $140,000. $140,000 in year 5. There are properties that are selling for $140,000, B-class properties in DFW right now at $140,000 and even higher. So we're looking at a 5-year valuation that is very, very conservative. So I think our numbers are very, very conservative and even sandbagged in areas. So this is going to do even better. So with our 12-year 2.91% loan, we don't have to sell it, but I put in a sale in year 5 so that we could sell it on an assumption, because you need to have 5 years left to be able to do a supplemental at that point in time. So that would give potential buyers 7 years of additional low interest if they want to assume it. We budgeted 3% rental increases when historically speaking, it's been 3.5. And we only have 26 units to upgrade, so that's going to help us on that part. Now, again, this is a beautiful property. They've got private patios and balconies, large walk-in closets, full-size bathtubs, washer and dryer connections, wood-burning fireplaces, which is nice, ceiling fans, all-electric kitchens, microwave, self-cleaning oven, frost-free refrigerator, ice maker. And as far as exterior, we've got a pool, playground, volleyball. Actually, we have a volleyball court in there, a roller hockey sports court, barbecue grills, and it is a beautiful property. We're folding in right with our other one. So this is a great investment for sophisticated investors. Now, also because it's for sophisticated investors, our minimum investment is only $50,000 on this deal. And this is going to provide great cash flow, 8% per year, 8% year one, and going up from there, and an overall average of 16.7. So we fully anticipate this filling up almost immediately. We only need to raise $3 million, an extra $360,000 or so when we get our final numbers from our lender on what they want to put in reserves. That if you want to be as a separate part, do the 10% loan on that portion, then you're able to do that as well. But this will fill up real fast. We're only needing to raise $3 million plus the $360,000 or so for lender reserves. So this will fill up quick. Our sophisticated partners have been waiting patiently for a deal just like this. And so 16.7% average return with immediate cash flow, 80s construction, fold it right in with our current property we own right next door already. And then on an exit, we'll look at selling those two properties together as a larger asset. So this is a great deal. I'm very excited about it. I'm happy that we can get our sophisticated partners in there because we want to make those sophisticated partners accredited investors by increasing their net worth as much as possible so that they can be accredited and be involved in every single deal. So make sure to reach out to David or Jeremy or Garrett to go ahead and get your investment in on this as soon as possible. It will fill up fast. So, David, do we have any questions?
Yeah, we've got a few. Going back to the management efficiencies, can you give an example of a management or maintenance efficiency that will gain by combining the properties? And where will the management staff actually office? Will they be in the corners or will they be in Riverbend?
Here's what we've got is the corners is only 85 units. They've got a small office. We can actually convert that office to another unit if we want to because it's an individual small building there by itself. So we're going to manage both of these properties out of the Riverbend office. Now, the corners would have 2 employees and Riverbend would have 3 or 4. So by combining them, we could probably get away with 4 or 5 total employees. And then we divide up their time. We allocate, when we do payroll, we allocate the time that they spend on each property. For ease, we might even break it up per unit so that it's divided up equally because we will be using the office at Riverbend. And because of that, it's a nice big office. We've just completely remodeled Riverbend top to bottom, and it's in gorgeous shape and a nice big office. So they'll be officing and handling that out of Riverbend. And what's funny is Riverbend's office, where it's located, would actually now be in the center of a large square between Riverbend and the corners. So the office is already centrally located to handle both properties on the side street. The road is called David. So it is already right there. It's not across a main street. It's not across a major thoroughfare. It's just like being in the same parking lot.
Okay, so we have another question. You mentioned there were 26 units to update previously. Someone's asking, are those units occupied, and how long will it take to make those updates?
Okay, so the 26 units, they are occupied, and people are in there paying rents. But as those leases expire, we're going to be raising those rents to market anyway, which will probably force them out of those units so that we can then rehab those. So, because you got to assume that somebody can move into one of those units today and be in there for 12 months. So it could take us as long as 12 months to go ahead and get that accomplished, because we would have to wait for their lease to expire, have them move out, redo the unit, and then release it. So, but most of them are in progress in the middle of a lease right now. Lease could be ending, it could be in the middle, it could be at the beginning. That I don't have the data on in front of me, but bottom line is we budget 1 year to go through and turn all of those units and bring them up to the higher rent.
Okay, here's another question. You mentioned sophisticated investors, of course, before are able to invest in this deal. Someone's asking, can accredited investors also invest in this deal?
Oh, absolutely. The way that works is a 506B offering. We cannot advertise, and we can do it to friends and family and people we know, people we have relationships with. And those people that are sophisticated, that we have a relationship with, they can invest in this. But the accredited investors, that's for a 506C offering. And accredited investors only are allowed to invest in those deals, those 506Cs, which our last two deals have been 506Cs because we've advertised them. So we got to make sure we stay in compliance with SEC. And because of that, we needed to have another deal that's available for our sophisticated people, but we're open to sophisticated and accredited.
Okay, good. I can answer this one. When will the PPM be available? It's available right now as you're at this webinar. Just log into your IMS account. By the way, this is David Tuttle. I didn't even mention, I'm just jumping in here like this. But you can log into your IMS account, or you can email me, david@darwingerman.com, if you do not have an IMS account with us, which is our internal portal. Okay, so that's the PPM. When is the closing?
The closing is going to be about 45 days from now. Just as long as it takes us to get the debt taken care of and placed. We have as much as 60 days, but we're anticipating getting this closed out and done in the next 45.
So that leads to the next question: is when will funds be due? And I mean, we'll need funds probably in about 30 days. We usually set a deadline about 2 weeks out from closing, so we'll communicate with you on email for funds.
Exactly.
That's
and all they have to do first is fill out the subscription agreement to get over to you. They don't have to go through the third-party accreditation. And just as long as we have the subscription agreement now, then that holds their place, and then we can get the cash in just before closing.
Yep, and you can e-sign the subscription agreement through your IMS account as well as look at the PPM.
All right, awesome. This has been a great time and had some fumbles in there, but I think that we have a great deal here, and sophisticated investors, this is your deal. All right, thank you so much. Make sure to participate. And again, we are always here to answer your questions, so reach out to us and we'll do everything we can to help you. Thank you so much.
All right, take care. Bye, Darwin.